Hello, this is CJ Wells, property manager at Invalesco Real Estate. Hey, since I advocate and I work with landlords, investors, and I also advocate for the rental properties that I manage, I like to just keep everyone on the team up to date as far as the things that are happening in the market around finances, since that's a big part of what investors bring to the team, which I call the triple constraint, is they bring lender funds. So Freddie and Fannie Mae, they are making some changes with their policies. But first, let me just quickly show you our website. Here it is in Valesco. We do development and we also do residential real estate and property management. I just want to give you a quick look at that. So what is happening? So this change of policy, and I'll get more specific on that, which happened last week, the week of March 14th, is Fannie Mae, who's quite a big buyer of conventional loans from lenders here on the streets. Well, they announced some changes that will make it more challenging for investors to obtain financing for additional investment properties that fill out their portfolios. Now, what's the reason for this change? Well, the change has to do with what started with the Treasury Department. It's a regulation that is aimed at limiting the Treasury Department's risk for these types of loans. And when I say limits their risk, well, they transfer that risk to the lenders. The risk of these particular types of loans from Freddie and Fannie Mae. And so now the companies the lenders, now they'll probably be changing their criteria and their fees and their interest rates. And all of this goes into effect April 1st, 2021. Now, all of this actually started in January, Thursday, January 14th of 2021. And we'll drill down into that from an actual article. So we're going to be seeing probably a spike in contracts that fall out of the running in the next several months, and probably through the spring and into the summer. Let's take a look at, let's unpack this more and get some details on this. There's our website. Okay, this is an article published Thursday, the 18th of March, from a San Bernardino, California newspaper, the Daily Bulletin. And it's titled Loan Costs for Second Homes and Rentals to Spike Under New Freddie and Fannie Mae Rules. Now, I'm just going to stick to the rental investment properties here, not so much second homes going through this article. So the author asks the question, do residential rental properties with 1 to 4 units carry more risk? Well, the U.S. Department of Treasury thinks so. Now, these loans are underwritten by Fannie and Freddie Mac. They do purchase these conventional loans, and they'll probably end up costing investors more money because of the restrictions that were announced in January of 2021. Does anyone remember that announcement? I'm sure some of us, heavy investors, certainly paid attention to that. So this amendment, so what it actually does is it changes the preferred stock purchase agreements with Freddie and Fannie Mae. And this amendment puts in check a system created by the Treasury during the 2008 mortgage meltdown. So in effect, the U.S. Department of Treasury, this system process that was put in place in 2008, Steve Mnuchin, that is the U.S. Treasury Department, they made some changes, probably some stop gaps to eliminate their risk because they were wide open. So what this change does is it puts a 7% limit on investment and second home mortgages. it purchases from nation's mortgage shops. And this is pretty huge, actually. Freddie has not announced the change, but the Treasury agreement is the same, 7% for Freddie and Fannie Mae, both. So how are things looking on the streets? That is the streets where the lenders live, where the lenders issue these conventional loans. Well, the lenders will probably step away from these types of loans, especially if they're worried that Fannie or Freddie may not buy these loans from them, because who knows if they will be over that 7% restriction. There's no cheaper mortgage financing sourcing out there than Freddie and Fannie Mae. In fact, mortgage money sources require more money down and charges higher interest rates and points. There's no point in funding a loan that might eventually be sold at an interest rate loss elsewhere. And this is why I said at the beginning of this video that there's probably going to be a lot of contracts falling through April, May, and June of this year. So the author here, he actually called several lenders, 5 lenders, to just chat with them about this change, about this change and how it would impact the prices for loans. And many, when he called them, chatted with them, well, these lenders, they're already ahead of the game. They saw this coming down. They've already increased financing of investment properties by an average of 1.65 points. Wow. And another way to look at this is, say an investment property of $500,000, then that would add an additional $8,250 out of the lender, out of the borrower's pocket, which is pretty high. Now, one lender, and in this article, the author calls it a behemoth lender. So I'm assuming it's anywhere, it's like a Chase Manhattan or, maybe a Bank of America, but behemoth, I don't know if the HBC, the Hong Kong bank, not sure. Anyway, but it's a large bank. They said that they have not changed their investor pricing yet. That could change at any time. But as of the writing of this article, Thursday, March 18th, they have not done so. So, of course, these large banks, which the author calls behemoth, these larger volume lenders have an advantage in this game-changing agreement, because it's easy for them to stay within this 7% limit on, say, $100 billion of Fannie and Freddie Mae loans, compared with, say, a smaller shop who's working with, say, just $1 billion in loans. Now, what does the who is this gentleman? He's part of the banker mortgage group. He was asked, and he said, applying these limits at the lender level rather than managing them at the GSE level, that is Fannie and Freddie Mac level, instead of the actual lender on the street, creates a potential for significant market disruption. That's maybe putting it lightly. We'll actually see probably in the next 3 months very easily. He says that they would like a better understanding to understand what flexibility FHFA, Fannie, okay, and Treasury have, and whether other approaches from the GSEs would get them below the PSPA thresholds this year, put in more efficient and less disruptive manner. So this is going to be rather exciting coming up. So what is this final one? The U.S. Department of the Treasury, they were called also, and they did not respond to this author's query about the consequence for small lenders and what's going to happen to them, as well as mortgage shoppers, such as landlords and landlords/investors. And the Treasury wouldn't respond either. As far as Treasury Secretary Janet Yellen, if she would reverse or amend this January 14th, 2021 preferred stock purchase agreement. That's what it actually is. So this is very exciting times, and feel free to drill down with the actual numbers on this. But this is CJ Wells, property manager. Just want to give you guys a heads up. We're going to have some pretty exciting times, and the market will be filled. If there's a vacuum, if there's a gap, it will be filled by other types of lending and lenders. We always seem to adjust to that. But this is not a big surprise. We probably figured that a change like this would be happening, especially the last few days of Steve Mnuchin's time in office, and it's hitting us right now. So hold on to your socks. I think we're going to be in for some very exciting times here. This is CJ from Invalesco Real Estate, property manager here. And feel free to give me a call if you'd like to chat. It's always good to stay abreast of what's happening in the market. And I love to talk about real estate, and especially property management. My landline number for you is 720-283-3110. And for now, this is CJ. Talk to you later. Bye.